let's go ahead and begin. First off, I want to thank everybody for coming. It's great to have you all here. So thank you for coming to price action trading class. Hopefully you all are having a good trading week so far. Last week was definitely very interesting. We had a lot of key moves and a lot of key levels broken. We've had some really good price action setups to start off this week. We're going to be going over one that I had recently blogged about that worked out really well. But we're going to start with a trade that I had taken last week that was a purely price action setup. And we're going to go through it from beginning to end. We're going to go through what I saw in a price action, from a price action status or level, or what I was reading from the price action that gave me clues that this is the trade I want to take, this is why I want to take it, this is how I want to take it, this is, where I want to get in, entry, exit, the whole thing. And so we're going to go through that. And that's, that's what we've been doing here. And I feel like you guys are starting to really get it, especially the ones who've been coming again and again and again are starting to kind of pick up on the cues and the signals and some of the things I do to spot these opportunities, because some of you are starting to anticipate some of the things I'm going to say to some degree. Like I'll ask you, hey, what do you see here? And you guys are picking out the right things. So for those of you that keep coming back and have been coming back, continue with that. You guys are definitely progressing. And more than likely you're seeing it in your trading. We actually have one trader in here named Ekleva, who wrote me just recently and wrote something very positive. And this was kind of the greatest joy for me. Anytime a student, takes some of these things, learns from them, and makes a really good trade and really starts to make changes in the trading, that was, fantastic to see. So they said, thanks for your efforts at the FX Street webinars, these valuable webinars. Through these, I've been able to achieve some success in recent days on the pound dollar. Your price action is great. The last two trades based on fibs and price action. The last one was a price action because of the fib extension. He goes on, and it looks like Ekleva hit some very good winners here. Some very, very nice trades. So, yeah, it looks like nice 80 pip and 120 pip on this one. So well done on that. Congratulations on that. They sent me the chart of the trades, and they even showed me a screenshot of their actual trade station to confirm the actual trades, the entries, what they did. And so, well done on that. Congratulations to you. It was an excellent trade. 80 and 120, it's a total of 200 pips. Well done on that. And that's all through price action and Fibonacci. So, they've been coming to this class for a while now. I definitely remember you and your name. And so, keep coming back. Things like this will continue to happen. And I hope, many more returns to this. So, with that being said, I want to go ahead and begin with a trade that I had taken last week, and this was on the, excuse me for a second, so I was just making sure all that I was up to date on comments and there was no questions. Oh yeah, before I begin, my apologies. For those of you that are new, because I am seeing some new names, please go ahead and feel free to ask questions at any point in time. I want you to feel totally comfortable. This webinar is being recorded as well, so by asking questions, if something is really on your mind, you get to ask it. It will be recorded on here, and then you get to review it, later in case that question comes up again. So this whole thing is being recorded, but don't hesitate to ask questions. Since it's being recorded, you'll get them answered, and then you don't have to remember them. All right, so let's go ahead and begin with the trade that I took most recently on Euro-Swiss last week. And as you can see, Euro-Swiss has been in a relatively consistent trend, and it had a few with trend failures above the 20 EMA that continued with the trends here, rejection off it as well. And everybody knows I've been following this for a long time. We had a very strong bounce off the bottom here. Very, very strong bounce off the bottom. And from that, we had 4 days of straight buying, and the thing, the pair went from, I think it was a low of 102, or actually went sub that. It went down to just almost parity and bounced within 4 days up to 115. This is an incredibly strong bounce. We could talk about some of the reasons that the Swiss National Bank has finally stepped up to the plate and really drawn a line in the sand, and people are taking it People are taking it very seriously. They're much more concerned about trading against, or buying the Swiss franc, selling euros against the Swiss franc. So sentiment's changed a little bit against this to some degree, and we can see this in the price action. 4 days of massive climbing. This is the largest candle to date, and for the entire year. From an open to close basis, this is the largest candle to date. So to me, this communicates an extraordinary amount of participation. The candles after that do decrease in size, but that's not surprising because usually it's that first punch that really kind of changes things. But the buying was strong after that. Then the market runs exactly into 115. And this is where I start to watch it. And we're going to zoom in a little bit here. And so I start to watch it and say, okay, it runs into 115, but how did it run into 115? And we'll get to your questions in just a moment here. So it gets really close to it. It opens. The market sells off after 3 days of straight buying, hits off to both the Fibonacci and the 20 MA, one of my favorite trades after breaking a 20 MA, looking for a trend pullback to the 20 MA and taking that with trend. But that's not the trade I took. I was really watching this over the last several days, week and a half, saying, okay, it was bought up, and then the market pushed really high and closed towards the highs. Then the next day, it hits off 115, and what does it do? It rejects, sells off, and then again finds buying pressure towards the bottom here, towards these lows, not too far off the 20 MA, and then gets bought back up. So it rejects pretty good, hitting a low of 12.19 and closing at 13.90. So it bounced 170 pips off the lows. To me, that communicates there was a pretty strong amount of buying. There was obviously two-way interest. Some people were interested in rejecting it off 1,500, enough to send it from 1,500 to 12.19. So you're talking a 300 pip drop. But then after a 300 pip drop, did it continue to fall after that? No, it bounced within the same day an extra 190 pips of those 300. So to me, that communicates that there was some pretty strong buying interest here, but there's still two-way interest. The next day communicates the exact same thing, literally. Opens, finds that same 1520 resistance, sells off, finds a little bit of support, just a tad higher, which is actually good. But the bottom line is we're still at a two-way interest situation. So there isn't quite a situation or a setup. Now, this is where it starts to get interesting. Over the next 1, 2, 3, 4, 5 days, but let's take these 4 right here. Over the next 4 days, it has one more day of selling off and then 3 days of gentle buying. Now, I started to look at this and say, wait a minute. We had 4 days where the pair climbed almost 1,500 pips, and in a matter of 4 days, and then for 1, 2, 3, 4, 5, 6, 7 days, it goes absolutely nowhere. Now, with that being said, if you have 4 days where it has 1,500 pips of buying, and then you have 7 days where it doesn't go absolutely anywhere, well, that communicates to me that there's a decent chance that the people who are last in control of the market are still in control of the market. We haven't seen anything from a price action perspective that would communicate that the sellers have taken over. We do see two-way interest, but there's nothing that communicates that they have taken over the market. In fact, as this continues, if you notice, the lows start to continue to get higher. They start to kind of cradle their way up a little bit. And so I'm watching this saying, you know what? Sellers haven't taken control of it. They haven't shown me anything that they've taken control of it. And so I say, I'm thinking this thing is going to go long on this one here. So that's where I start to draw the fib, which you saw here. Now, I drew it from 2 places, and I think somebody had a question about it. But I drew it from here, and it lined up very nicely with the 1,500, the resistance levels here, the support levels here. And then I said, okay, let's redraw it just to make sure as well and see if we got anything else. And I drew it from this swing here, and it virtually came out to the same place. It was off about by 20 or 30 pips. But on a daily chart and on a move that we're talking, 1,500 pips in a matter of 4 days, 30 pips is not that much. The fact of the matter is they both were coming right around the same level. So I said, okay, whether it's this one or whether it's this one, the bottom line is the market is finding some resistance here. And since the sellers have not taken control of the market, and I keep seeing this thing pick up higher and higher, this is communicating to me that it's all communicating to me that the market is eager and happy to buy it up a little bit higher. They're continually buying up a little bit higher. Each one of these candles is higher than the next from the lows. Now this is where it starts to get interesting. I had made the decision that I was looking for a buy, and that's when I saw this thing right here. I saw this thing right here. Boom. Hits off this level here, hits off 1500, sells off, and closes on the lows. Now this isn't a stifling candle by any means. Again, it hasn't communicated to me that the market has switched hands from the buyers to the sellers. You know, what would communicate that to me? A selling candle that took out all these lows over here, takes out the 20 MA, maybe even takes out this. Then that would say, okay, the market, the sellers have taken over. I want to be looking for short to medium term sells. But I saw none of that. None of that whatsoever. Now, this was the first day of, I wouldn't even call it moderate. I'd still call it like selling because, again, the lows are higher every single day in a row for 7 days. What happens after a day where it rejects off of 1500, sells off, and closes at 1400 pretty much on the lows? It was literally a close 1 pip off the low. So that communicates to me, well, there was selling pressure for this day that was strong enough to at least close towards the low, but not to make any significant lows. So I said, okay, let's see what happens to the next candles. The next candle opens up at 1400. It makes a low 5 pips lower, and then it starts to climb. This was after a day that had closed towards the lows here. So it opens, goes 5 pips lower, and then starts to climb all the way towards this 1500. And I said, you know what? That looks like a candle that wants to break out. Why did I notice that was the candle? First of all, we already had all of the buying pressure with the higher lows and the buyers still in control. But then we also had a candle that opened and was bought up from the very beginning. So the candle was bought up from the very beginning and literally pushed straight towards that 1500 level. So I said, you know what? Normally I like to take a breakout retest in this after it's been, tested several times. But I said, you know what? I'm going to take a breakout of this. I like the breakout of this. And so here was the actual high of this one here. It came in at 1554. I got in at literally 1560. Because I have an affection for numbers that end in threes, so 30, 60, that kind of thing. So with that being said, I bought at 1560. Now, what was my stop on this one, and what was my target, and how did I draw those? To do that, I have to zoom back just a little bit here. Now, we'll keep the fib on. It doesn't matter which fib we use. They both worked out pretty well. I looked at this and said, look, it's breaking out over here. We've had 7 days of higher lows. 20 MA is curling up to support it, and this thing was bought up from the open. It's now broken the prior highs, and so I'm going long on this one here. Literally 6 pips above it. Now, with that being said, I said, well, wait a minute, what's my target on this one? I said, do I want to target the fib, or do I want to target something else? And when I decided between it, I decided actually to target just shy of this right here. Why? Because it was a rejection here. It was a prior swing low over here, which caused a 5-day bounce. And I said, you know what? Very simple. I'm going to target this here. Now, what did I use as my stop? This is the first time, actually, that I had literally a 1 target and 1 stop. Normally, I have a 2 targets, sometimes 3 targets, depending upon the position. But in the case of this one, I really just made it a mano y mano. It's pretty rare that I do that, but I decided to make it a mano y mano because I didn't necessarily feel like it had medium to long-term prospects beyond this without running into some trouble, say at 120, which was not too far above. So I said, let's just make this mano-a-mano, and this is where I'm drawing my target. Now, show you what this looks like on a 4-hour. Believe it or not, I actually didn't even look at a 4-hour time frame on this. But I just want to show you what it looks like. Here is the market open, basically, right here. This is where the market opens, right about here. Just a few pips below that. So this is the market open. As you can see, yeah, we did have, and let me delete the fibs. You can see we did have some rejections off of 1500, but we had wicks on both sides of the market. And the sellers didn't obviously take control, because if they did, these candles would be getting larger and they would be breaking lows, but we weren't seeing that. As they sold aggressively here and tried to double attack it, the orders kept getting absorbed, and then it starts to change hands from more red candles to more blue candles. Do you see the change of hands from the red candles to the blue candles here? It's subtle, but it's there. Let me know if you see it. And I will tell you, I'll tell you stop on this one here and everything. So give me just one. Does everybody see that though? The change of hands? I see it after you show it to us. Well, that is okay, because, you know, you're not going to necessarily see all these ahead of time, but by seeing these, I mean, remember, I didn't get in until this candle right here. This is where I got in, which was this candle right here on the 26th. So I got in on a Friday morning, literally right around the London Open, which is right around 5 a.m. Buenos Aires time. But if you look at it, the change of hands had already happened. So I had already seen this change of hands. The point is, yeah, of course you may not have spotted it now, or you may not have spotted it back then, but by me pointing out these patterns to you, if you learn to see this again and again and again, you come back to these classes again and again and again, then you will start to recognize these patterns in your own trading. Eventually you will start to recognize these patterns. Just as Eklavo was able to spot one of the trading opportunity from some of the techniques we talk about in this class. So now let me talk about my stop and then how I played it going into the weekend, because it was going into the weekend, which is generally not my favorite thing. Let me talk about how I played it going into the weekend, and then that was it. So going back to the daily chart, and we will maybe go back to the 4-hour time frame just to break it down a little bit more. Here is the entry. Okay. So pulling back, take either fib, doesn't really matter. They both played out the same. Pretty much. Very subtle differences. Well, let's go with the original one. Okay. Zooming in, 1560 entry, 1 pip off. We'll just leave it there. I had a decision to make here. I said, do I think that the 1500 in this Fibonacci level is going to hold, or do I want to place my stop below these two candles here? When I trade a breakout and I'm going to buy on the break, normally I like to look for a breakout retest, but I didn't feel that this was going to happen. So when I trade a breakout, I usually like to employ a rule of last day or last candle rule, which was the candle that was the one that broke out. That's where I put my stop just below it. So this is the daily chart right now that you're looking at. You're not looking at the 4-hour, you're looking at the daily chart. And normally I like to say, okay, this is the last candle that I like to do that. But I thought about this. I said, wait a minute, that's a 180 pip stop, and I have a 300, or not 300, 1560 to the 1812, also the great overture, if anybody knows classical music. My target was actually literally 1799. because I felt like it should go past it, but I don't want to get snagged by these rejections here. So literally 17.99, I felt comfortable with that. So there was my target. So I said, wait a minute, I have only a 220 pip target or 230 pip target. If I do the last candle rule, I don't feel comfortable about taking, having a 180 pip stop. It's not, especially since it's a 1-to-1, it's not my favorite R to R situation. I generally like 2 or 3 or more, sometimes I can spot even 5 or 8-to-1 trade. In fact, I think a week or two ago I showed you a 5 or 8-to-1 trade. So I said, well, wait a minute. Is there any other level that I feel comfortable that I would find protection? And I said, yes, there was another level. I looked at this here and I saw a series of closes that were right around this level here at 1471. And I thought to myself, you know what? I have the fib, I have the 1500 level, and I have these closes. Let's put it at 1460. So then I balanced the ratio out by having a 100 pip stop and a 230 pip target. So now I had a 2.3 to 1 reward to risk on this one here. That felt comfortable to me. That felt like, okay, I feel comfortable enough that I should find some protection at this level, that the fib should hold. I mean, at the time I bought it was 1560. So if it starts to reverse back, take out the fib at 1516, take out 1500, which would be a 60 pip drop from my buying point, and then another 40, then I was wrong. I didn't need to be any more wrong than that. I felt like that was enough to say I was wrong at this point. So with that being said, it was enough for me to say I don't need to do the last day rule, so let's find a much more precise entry. But this was all done on the daily chart. I never did this by looking at a 4-hour or a 1 hour or anything like that. It was all done on the daily chart. Well, how does it end? It closes Friday. It had a high of 1735 and it closed at 1700. So closes on the round figure and it closes very, very close to the high. And I said, now I have a decision to make. The decision to make is, do I just say, hey, I'm up 140 going into the close? Do I just say, hey, let's just take the 140 and call it a wash and not hold it over the weekend? Or do I feel like this could really go a lot further? It could go to my target. And I sat there and said to myself, well, let's look at this. Let's play this out for a second. There is a fair amount of weekend risk. You just have that event risk that is in play in the market. So that wasn't working for me. I didn't feel too comfortable about that. But then I said to myself, wait a minute, you're also up about 140 points. And so with that being said, being up 140 points, do you feel pretty confident that you have enough profit locked in at this point to say, hey, we can at least neutralize all the risk? And I said, absolutely, without a doubt. I'm up 140. There's no reason why I should be losing money at this point. So what did I do? I literally moved the stop at this point to break even plus cost. And just said, hey, spread was about 2 pips on this one here, so moved it to 115.62. And I said, if it comes back 140, which I would be impressed if it did that, without running into any resistance. We haven't hit any resistance at this point. So we're kind of in between, and it's rarely in between lows and highs that markets start to reverse. It's very rare that markets do that. There wasn't any sort of order flow at those levels before, so why should there be order flow at those levels now? Generally doesn't happen. I couldn't find anything that suggested no, and then I said to myself, you know what? Let's go ahead and run with the trade. Why not? I'm up 140. If it turns around, no big deal. There's no money lost at this point. I've covered my costs, and that was that. I felt confident that we had broken the key levels and that there was nothing in the way between me and my profit target, which is literally only another 90 pips away. I've already gone, 60% of that venture. I feel comfortable that even if it comes back a little bit, that it'll find buyers and it will continue on up. The close was so strong, and this was the final point, the close was so strong that they closed very close to the highs. Keep in mind, this candle went from 1400 lows or 1395 lows to a 1735 high. That's 340 pip advance. On a 340 pip advance, there was very little profit taking, only 30 pips off the highs. So what did that tell me? Buying was going into the close. Nobody was profit taking into the weekend. Therefore, the buyers are in control. And the last point, official last point, because we had just broken out a key level, everything was communicating to me. We had taken out the previous stops over there, whatever there was at 1500. We had taken out the bears. Buyers are all in control. So let's hold for the weekend. And that was it. And so I held over the weekend. And the market performed actually as I had suspected or intuited. It opened at 1699. It had a low of 1686. It literally dropped 13 points from the open and then started to climb right off the bat. And within a few hours later, hit the target, and that was it. 230 locked with a 100 pip stop. Okay, so with that being said, does everybody see the methodology I used? Does everybody see how I was able to interpret the price action? I was able to spot this opportunity, how I was able to pick my stop, I was able to pick my limits, how I chose the limits, what price action things, what cues I saw to kind of alert me to all. Did everybody see that? Yes? Solomon says, I don't understand the change of hand. Okay, so let's get into that, and then let's get into the questions, because there's a long list of questions here. All right. Change of hands is when change of hands is referring to order flow. You have participants, anytime somebody's participating in the market, they're talking about either the buying, they are participating in the buying side or the selling side. They're choosing a direction. They want to go up, they want to go down. Those are, and when I say change of hands, it's kind of an expression from poker, but it's generally talking about saying, hey, there was a change of hands between who was in charge at that moment. Well, when we go back to that 4-hour chart, which is what I was referring to, the change of hands, delete all these lines, buyers were clearly in control. They make a last push. They reject off the 1500 level. And the sellers start to kind of say, okay, we're going to push back a little bit. They reject off a couple times here, showing that they're not accepting the prices here for whatever reason. And they make a decent pushback with the candle here and the candle here. But the bottom line is this, is that you can see the market was predominantly blue, which means that the buyers were in control. Okay? Even here, you can see that. All the way up through here, there's more blue candles than red. But this is where it starts to change hands in the sense of we're having more selling candles than buying. So from here to here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Over 11 candles, there's only 3 blue. That means for 8, which should be 32 hours, out of 44, 32 out of 44 hours is all selling. The sellers are in control from a time perspective. Now, to have dominated at least that 4-hour candle, to have sold it after something had advanced 1,500 pips off the lows in very violent fashion over 4 days, to have done this, and then all of a sudden switch over to where 32 out of 44 hours, the sellers are at least in moderate control to the point where they, as the candle closes, it closes down. You can see that that was a change of hands. The sellers are subtly in control. But they started to lose their control, and you can see it because their pressure was getting smaller. How do I know that? Because the candles were getting smaller. Other than these 2 big candles, this candle is smaller than this one, and all these candles are very tiny in size. So with that being said, I was noticing that, yes, the sellers are in control for these 11 candles, but now they're starting to lose control, which is here, because now you're starting to see more blue than red. So from this point on, you can see It's much more predominantly blue. For every 3 candles, 2 of them are blue. And the blue candles are holding up their ground and being supported by the 20 MA. So that's why, or that's what I meant about changing of hands. Does that make sense now when I talk about the changing of hands, Solomon? Okay, fantastic. All right, let me scroll back and see what questions we have at this point. Luke, did I answer your question about the fibs? I actually pulled both fibs. Did I answer your question, though, about why, I mean, in some sense I answered. I pulled them both, and they both played out the same. So let me know if that answers your question. Seems there's 2 people chatting a lot in here. It's good. It's good that traders get to meet each other. Okay, so Gabriel, I think answered your question of where I put my stop loss. Let's see, next question. Abel says yes, active margin. I'm not sure what that means. Aviator says great entry. Okay, Eklova, did I also explain the change of hands? Let me know if I did. Michael says I waited for a retest on this one and missed it. I'm always very wary of entering breakouts. Maybe after I start your PA course, I may recognize the nuances more. There's actually several systems, Michael, on the course about teaching direct breakouts and what are the exact price action formations you want to see. So that's something you can learn easily. Aviator says after coming to class, you start noticing. Good, fantastic. Boyke says, why do patterns repeat? Okay, so I can answer that question from a trading perspective. If you're talking about a broader, that question could be a broader philosophical question as to why patterns repeat and humans and nature, and I'd rather not get into that philosophical question. But in terms of why do patterns repeat, I'll give you 2 answers. The one answer is human nature. What is the market composed of? It's composed of humans making trades. And it's also composed of algorithms making trades. Well, what are algorithms looking for? They're looking for patterns in the market. They're looking for patterns that are exploitable. And the bottom line is, because the market is really decided by order flow, doesn't matter why somebody gets in, the total summation of all the orders comprises the order flow, and that's what causes price to move. Beyond that is pure speculation as to why the market moved. So the total amount of order flow is done by humans and algos, and we tend to operate based on patterns. We like things familiar. I mean, if the whole world, if everything was chaotic, you walked into your house one day and the key the key for your, or the, where you put in, your key into the door was on the right side of the door, and the next day was on the left side of the door, and the next day was on top, we'd have no way of operating. So we operate and we function very well with patterns, and that's how, because it's human nature, and that's how we tend to think, and our brains are more biologically designed to think in more pattern ways, that's why they're patterns. But the other answer to it, is, I could get into a huge philosophical discussion, but the bottom line is it's much more comfortable for us to relate to patterns than it is to relate to chaos. And so, since we all see patterns, and we all, especially the most experienced ones, we see patterns, we see the same patterns again and again and again, we end up trading them relatively the same, because once we know how to trade them, we're not going to stop trading them that way until we're proven otherwise. And so, that's really the answer behind it. So, Riskwing says, I see here the logic of breaking out the highs, but I don't see the logic about choosing not the highest high when pulling the fib. Is this 50% Fibonacci really valid, or is it only breakout of highs? Your question, Right Wing, actually precludes that there is an ultimate truth to the correct way to pull a Fibonacci, that one Fibonacci is superior to the other. And I think that's a preclusion or an assumption that you can't necessarily make. Sure, we could pull it from these highs, or we could pull it from these highs, and the question then becomes, which one is more legitimate? Well, some Fibonacci traders would say, hey, this swing ended right about here. It made a counter move swing here, completely cleared out the 20 EMA, and so therefore we have to pull it from this swing. Some other Fib traders might say, hey, this is actually the last swing, and some of them might say, hey, this one here. And then some of them might go back and say, well, wait a minute, we got to go much higher than that, and we got to go to here or to here or to here. The problem with Fibonacci is it's not a perfect science in the sense that it's not totally objective. You can't assume that Fibonacci, there is an absolute perfect way to trade it, and there is absolute not perfect way to trade it. There are more skilled ways to trade it, and there are less skilled ways to trade it. And so the question is this 50% Fibonacci really valid, or is it only breakout of the highs? Your question assumes that there is only one valid Fibonacci. And Fibonacci, professional Fibonacci traders would generally disagree with that. Why? Because they're not just looking for one fib, they're looking for a confluence. And the confluence can be either Fibonacci levels plus price action confirmation of it, or Fibonacci levels with other Fibonacci levels, or if you really want to get technical, Fibonacci with pi, or Fibonacci with sine waves, or C notes, depending on how far you really want to go deep into Fibonacci. There are many different things that they're going to look for all this to conform. And so with that being said, I challenge your question on the basis that it assumes that there is only one valid Fibonacci. Most of the professional, hardcore Fibonacci traders will never just pull a fib and say that's the absolute fib. They're trying to see, does it match up with prior price action? They're trying to see, does it match up with other fibs? Does it match up with other key support and resistance levels? And most of the Fibonacci traders I know are the ones that are saying, hey, this one matches up the best, so I'm going to go with that one. But if I put 10 Fibonacci experts in the same room, and isolate them, then I guarantee they're probably going to come up with various different forms of Fibonacci pulls on this. So that's my thoughts on that one there. And because mine lined up really well with price action, whether I drew it from here, or whether I drew it from here, or whether I drew it from here, these are the ones that lined up with price action the best, and those are the ones that were most suggestive to me that that's what the market is going to respond to. If I had to choose, I would probably say the market's more likely to respond to this one because this was the most recent direct swing. So that's my answer to that question. Does that answer your question? And while I'm doing that, please forgive me, I'm going to scroll down and look for a few more because I got several questions and only about 6 or 8 more minutes before I got to get going. So, okay, Solomon says, what is the rule for identifying the change of hands? First off, I've explained that, so let me know if I have. I think I've answered your question, but let me know if I haven't. Boyke says, why would you not wait for a retest of the breakout? This is an excellent question. It's really, and I'm going to give you 2 answers to that. One of them is, normally I do like to wait for the breakout retest. Normally I would prefer, if I had to choose and I was put in this situation 1,000 times over, or similar situations over 1,000 times, which I'm sure I have, I would generally prefer a breakout retest than an absolute breakout. But my price action instincts, and keep in mind I've been doing this for 10 years now, so I've seen just so many patterns. Everything was kind of communicating to me, there were some subtle hints that this was going to be the one where it broke out. One of them was, there was about 3 hints. One was, we had 7 candles that were just going nowhere except making higher lows. That was the first one, which told me that the buyers were still subtly in control and they were slowly squeezing out the sellers in this one here. If they weren't squeezing them out and it was an equal balance between the two, then you would see that the sellers would be pushing it back down to the same lows as to where they were before, but that wasn't happening. So there was one sense that the market was changing hands to the buyers much more favorably than the sellers. That was the first one. The second one was that we had hit this little 1500 level and then sold off and closed towards the lows. And that had communicated to me. And so that had communicated to me, okay, there was some decent, and excuse me here, there was some decent selling here because it closed off the lows. But then to follow that up the next day, open up and only go 5 pips lower and then start from a low of 1395 to 1560, it's a 170 pip run while from the open basically. So you open, you go down 5 pips, and then you climb 170 pips. That communicated to me that the force was there right then and now. The buying pressure was pushing right then and now. It was the first time that one candle had opened, gone 5 pips down in the first candle in the last 8 that had gone 5 pips down from the open and then climbed 160 pips from the open. So to me, it was very communicative that the timing was now. And so I said, I think this thing is just going to keep pushing, and that's why it's breaking out. Does that answer your question there, Boyke? Yes? Let me know if it does on why I took the breakout. Okay, I gotta burn through these questions, and then I gotta wrap it up here. Okay. Okay. Michael says, but you were going into holiday weekend. Any significance regarding risk? Absolutely. There definitely was, but I had neutralized all the risk. You got to remember, this is a paper profit. Until I close the trade, it's not a real profit. But I had neutralized all the risk by moving the stop to breaking and going into the weekend. So there was no more risk at this point. Rai says, so what is the next candle trading? I don't know. That's not how I approach the market. I apologize here. I don't approach the market saying, what's the next candle doing? Because I don't look at every candle as an opportunity and say, okay, I want to buy here, sell here, this is going up, this is going down. I don't find that to be an effective way to trade. You're going to end up having to make decisions on candles that are less meaningless than others, that there's less participation than others. And I like to participate and be involved in candles that are likely to drum up or already have communicate to me there's heavy participation, and it's already heavy participation in the direction that I want to go. So I don't look at this and say, hey, this candle's going to go here and here. And I generally don't make decisions mid-candle per se. You know, we're still mid-candle. We still got an hour and a half. I generally like to see at least it going. So I hopefully answered your question, right? I don't make decisions on every single candle. I think that's the worst thing a trader can do. And so that's just my thoughts on that one here. Okay. Is it possible to give another sample? Yes, Tim, next week. Come back next week. I'll definitely give another sample. There's not enough time in this class. Prancer, I apologize. I don't have time to look at the Kiwi 4-hour. I have to wrap up very soon. Same thing with your US dollar. Rice says, what time frame do you like to trade? That question I can't answer. I generally like to trade off of 4 hours and daily time frames, but maybe you're asking that question to somebody else, so I'm not sure because you're going to have a conversation with Trader 2. But yeah, I generally like to trade 4 hours and daily time frames. Ghana says, do you always count candles? No, but I usually like to do it when I'm most interested in possibly taking a position. And it's really just a quick snap. I just kind of look at it and say, okay, here's 4, this is 7. It's not hard for me to do that. I've been looking at charts for so long and so many years that for me I can just look at chunks of data and just say, hey, that's 4 candles, that's 7 candles, that's 12 candles, it's 50, 60%. I can just do that. It's just a pattern and ability I've developed over the last 10 years. So I generally only start counting candles when I start to get interested in taking a position or a trade. So hopefully it answers your question. Dry Desert says, you can think of the market like you have 2 turns, both pull on a rope, sometimes on 2 turns. Yeah, I can agree with that to many ways, Dry Desert. Avery says, okay, last 2 questions. Let's see. Ekleva says that Chris, I requested for some word of advice on gaps. In fact, you even asked the question twice. Ekleva, I'll respond to that via email, but you'll have to wait till I land in Uruguay. I'm flying out just after this. So when I land in Uruguay and get back to my email, I'll definitely respond to you on that one. Michael says, I think I've answered your question, Michael, about the fib. And, okay, last two quick questions, and then that's it. Chris, do you pay attention to COT data? Not really, because COT data is not all the contracts, it's just the futures contracts. And you got to remember the Forex market is spot, futures, swaps, options, and everything. And so I'm really concerned about reading price action in real time. You know, the futures can be useful, but I actually feel like I have better tools in A, reading price action, and B, some of my proprietary indicators and methods for really understanding, you know, what's going on in the underlying order flow. The COT report is generally useful at major inflection points to signify major reversals because the market is overextended on one side or the other. And again, but that's only counting futures. It's not counting spot or swaps or options or forwards. So with that being said, I like to look at the price action on the spot and really figure out, okay, is this market overextended or not? And I have some very simple tools to do that. So hopefully I answered your question. And last question. Oh, man, I want to answer this one. But Nev, your question on how are patterns and order flow linked, I'd love to answer that question, but I have to get going. Come back next week. I would love to answer that question. In fact, at the very beginning of the class, ask me that question. I'd love to start off with that question because it's such a fantastic question. It's one of really my underlying philosophies as to how and why I trade price action. So it's probably one of the best questions, you know, that you could possibly ask him regarding to this. So, okay. Anything I can answer super quick? Okay. Which chart station are you using? That's the last question. That's it. FX Trek and Telecharts. Okay. All right. Actually, one more last question. That's it. No, I'll ask a couple more quick ones. Blaze through these. Why do all new traders lose all their money in the first 2 months? Is it the broker or the skill? It's neither. I find generally that the most common reason why traders lose money in the very beginnings is because they really don't understand the nature of risk management, and they think that after a couple months of studying and trading that they're all of a sudden experts in a market that is incredibly vast and dense. It's kind of like, it would be like me never taking archery before, going into an archery class, and then expecting after 2 months to be an expert and constantly be hitting bullseye. That's the thing about it. It takes time to learn this. You have to have patience. You know, it's a little bit more difficult to have patience with this because it's centered around money. And we all generally like to have more money. I like to have more money, even though I feel like I have plenty right now. Of course I like having more. I like making more. I enjoy it. But I really enjoy, you know, the art of trading, the art and science of trading. It's not so much about money at me at this point. It's more about the enjoyment of it. But I really wish that if somebody was starting up trading, that they would also start up another skill-based endeavor, say like pool or archery or golf or something like that, something that's precision-based. And the reason being is this, is that if you've never done golf before, or you're very, very beginner at it, and then you start to take it up seriously, or archery or pool, you're going to find that precision, how important it is to be precise. Because a subtle adjustment in shooting a bow and arrow, and your arrow could either be on target or it can be 6 inches off or a foot off, depending on the distance. The same thing with pool. If you hit that ball with the wrong spin, you know, you could adjust the shot tremendously. If you hit the wrong angle, a subtle mishap in the angle, and you could miss the shot. Same thing with golf. It's such a precise thing. And so you start to see how all these little subtle things can have drastic effects on the outcome. And you also become very humbled by it because you don't all of a sudden think you're just going to become an expert in no time at all. The other reason why I recommend it is because money is not really involved in it. You're not going to make money by necessarily making a great archery shot. or pool shot or golf shot. You can if you bet on it, but not everything you do is based on money. So it gets you out of the habit of thinking about the money aspect, and it gets you into the habit of thinking of, how do I do this well? How do I do this right? How do I do this correctly? And as you start to actually approach the market from that perspective, then you really start to look at it with patience and say, hey, I'm going to learn how to do this really well. I'm not going to focus on the money so much. I'm going to learn how to do this well, because if I do it right, the money will come. If I learn how to hit a golf ball well, I'll make good shots. If I learn how to shoot a bow and arrow well, I will make good shots on the target. If I learn how to hit the pool ball at the right angles, at the right cue, the right adjustment of the spin, I will make more shots. It's the same thing in trading. If I learn how to do this well, I will make good trades. In the beginning, that generally doesn't happen. You get so caught, most spin gain traders get so caught up in the money, they make a trade, a demo trade, and all of a sudden they made $2,000, $3,000, $4,000 in a matter of like an hour or a day, and they're thinking, shoot, I only make that in a month or every 2 weeks, and I just made that in one day. I can make millions of dollars of doing this. And then they take their eye off the ball, and they get so focused on it that they employ poor risk management habits, and then they get themselves into bad positions, and they usually end up blowing their account because improper risk management. If everybody started off trading only 1% per trade at every single trade they did without fail, you would have to make 100 losing trades before you'd destroy your account. And even then, you may not do it, depending on how you adjust your risk management over time. So with that being said, you give yourself a greater window of opportunity to really learn how to do this correctly. So, excellent question, Solomon. That is my answer to it. And let's go ahead and, leave it on that. So, with that being said, I want to bid you all adieu. I want to say, hey, if you don't know this, I have a blog here, which you are welcome to look at on that link. It's on forexstreet.net. Generally, every single day I'm writing articles, so go ahead and check out the last several articles. Were fantastic, especially some key ones on price action. So go ahead and take a look at that. And so other than that, I want to bid you all adieu. I want to wish you really good luck trading, and I will see you guys next week. Take care, everyone.